there's really three key things that we're going to cover today. An overview of the second draw PPP loans for anybody that hasn't obtained that yet. We're going to look a little bit at the PPP forgiveness for the round one. And then we're going to spend a good chunk of time on the employee retention credit. Since really, I think most of you are at least familiar with the PPP at this point, but the employee retention credit is something that really hasn't gotten nearly the press or attention that the PPP has. So we'll spend far more time on that today. All right, so to be eligible for the second draw of the PPP, you must have been in operation on February 15th of 2020. So similar to the first round. And you had to have received a first draw PPP loan. If you have not received a first draw PPP loan, you are allowed to apply for that now under the same rules as the original application. Then the big test to meet the second draw is you had to have had a reduction of gross receipts in any quarter of 2020 compared to that same quarter in 2019. So most people hit that gross receipts reduction in the second quarter of 2020, since that's when many of the shutdown orders were in place. We've seen a few clients that have also hit that in the third quarter, but by and large, we're seeing it in Q2 2020. So dive into what this gross receipts reduction means a little bit. So you do have the option, instead of looking at it quarterly, you can use annual. So just comparing your 2020 tax return to your 2019 tax return. That's really if you're a Schedule C, you don't have quarterly financial statements, and you had a 25% reduction. It's easier to do it that way, but most of you are going to go under the quarterly test. If you started your business partway through 2019, you can use the third or fourth quarters of 2019 to compare to 2020 quarters. So there's been some question as to what gross receipts includes. And there are some specific things that it does include, which is over here on the left side. Your normal sales and revenue, interest, dividends, rents, royalties, fees, commissions, everything that you would consider normally as gross receipts. The one thing that's been popping up in a lot of questions are many of you received grants from either the county or state. Unless the IRS or Department of Treasury or SBA explicitly says otherwise, those are included in gross receipts. So if you received a $10,000 grant to help with personal protective equipment, that's going to count in the gross receipts test. Also included is if you're a physician, the HHS grants that they paid out, those are included in gross receipts. Now, one clarification on that is they had grants and they had advances on Medicare payments. The grants are included as gross receipts, but if you received that advance on Medicare payments, those are not included. Items that are not included in the gross receipts are any capital gains. So if you sold any equipment or anything, not included in it. Taxes that collected for and remitted to a taxing authority. So basically in Michigan, that's sales tax. And then any forgiveness of your PPP loan is not included either. So we'll go through the loan forgiveness fairly quickly. And the reason we'll go through it quickly is if your loan amount is under $150,000, the application is significantly simplified. So we don't need to go through a lot of the full-time equivalent gyrations that are in this, in the forgiveness detail. So one of the big changes was originally it had to be spent on 75% payroll and used in 8 weeks. Obviously that was extended to 24 weeks and only 60% of it needs to be used on payroll and the rest of it can be used on other expenses, which we'll cover on the next slide. But it is important to note that you can elect any period between 8 and 24 weeks. So you don't need to choose either 8 or 24. It's any period you want. And we'll see that potentially comes into play with the ERC later on. So the other eligible costs, originally it was basically mortgage interest, rent, and utilities were the 3 things that counted as other costs that we could spend the PPP funds on and get it forgiven. That list has been greatly expanded with the latest iteration. It now includes a lot of overhead costs. So operation expenditures, payments for any business software, cloud computing software, product or service delivery, processing, payment or tracking of payroll expenses, HR, sales and billing functions, accounting or tracking of supplies, inventory, records, and expenses. So that includes payroll fees, accounting fees, any cloud software provider that you have. It's included at other 40%. And then supplier costs. Anything that you purchased, basically, that's essential to your operations, that's allowed in the other costs. And then any personal protective equipment that you purchased is also included. So if you needed to put up plexiglass around your plant or in your waiting room, that's an allowable expenditure for the other 40%. As I mentioned earlier, we can now elect any period between 8 and 24 weeks for the covered period. So the FTE safe harbor, and again, this applies if your loan's over $150,000. You're eligible if the average FTEs from February 15th to April 26th are less than the FTEs in the February 15th payroll. So basically, if you laid anybody off between February 15th and April 26th, you become eligible for the safe harbor. And then what you need to do in order to meet the safe harbor is you need to restore the full amount of your full-time equivalent employees sometime before December 31st, 2020. So as long as you restored your FTEs, you'll qualify for the safe harbor. You're not required to hire back the same people. You can hire somebody else. And also if you tried to bring somebody back, which we had challenges with when the unemployment supplement was $600, we had people that didn't want to come back to work. If you made a written offer to that employee and they refuse to come back, it doesn't count against you. It still counts towards your full-time equivalents. And then same thing with the wage reduction. If you reduce their wages for whatever reason, as long as you restored them to their earlier levels, you're fine. All right. So it's in here. Most of you will meet the FTE safe harbor. If not, this is a calculation that you have to run through. So if you don't meet the safe harbor, you do end up with a proportionate reduction in the forgivable portion of the loan. And then you have the exceptions down here, which we talked about a little bit, was if you made an offer to a person, they refused to come back, doesn't count against you. If you had any employee that was fired for cause, it doesn't count against you. And any employee who voluntarily resigned or requested a reduction in hours doesn't count against you. So if you had somebody that retired in 2020, they're not going to punish you for not replacing them. Then similar methodology as the FTEs. If you reduce their wages and you didn't restore them, you reduce the forgivable portion of the loan. So to kind of recap the forgiveness, for loans under $150,000, they released it on, I believe, January 21st, this form 3508S. And I'll say that some of the banks are now accepting these and they have it built into their system. Some of them aren't ready to accept the applications yet. And as most of you know, unless you're with a small local bank, all of the national banks are doing it through online portals. It's going to be the same with the forgiveness, and some of them don't have this option loaded into their portals yet. But with the simplified form, you're not required to submit any documentation with the form. It's basically a one-page form saying how many employees that you had and how much of it was spent on payroll. So it's a pretty straightforward application, but I will emphasize that just because you're not required to submit the documentation, you are required to have it, because all of these PPP loans are subject to audit. No idea what that process is going to look like at this point, but you do need to have documentation for the information that you're submitting. And the same rules apply to this form. You put the amount that you used on payroll and then the other expenses. And then if you're over that $150,000, we still need to do the full application form, and I would urge you to be patient on that. You have 16 months to apply for forgiveness from when you initially received the loan. So that's going to put most people's due date in June, July, August of 2022. Or, sorry. Yep, 2021. And that should be. So be patient on that. As you know, in the past year, a lot of the rules and requirements of the PPP and the different relief programs have changed significantly from when they were released. I'm not saying that's going to happen again, but wouldn't be surprised if it does. So without any looming deadline, I'd encourage you to kind of put pause on the forgiveness applications, because again, there's no rush and there's no benefit to getting them in now. So now on to the employee retention credit. And this is one that you're probably not quite as familiar with, because it really doesn't make the headlines, but there is a potentially huge benefit hanging out there for those that are eligible. For 2020, you can get a credit of up to $5,000 per employee. So if you have 10 employees, you're potentially eligible for a $50,000 credit. And this is a refundable credit that you can get through your 941 payroll tax forms. The 2021 credit is even bigger. It's up to $14,000 per employee. So obviously you've got 10 employees, that's up to $140,000. Now, the reason that the 2021 credit is higher is there's far less people that are likely to be eligible for it. So there's two big things to meet the eligibility for the employee retention credit. The first one that's more straightforward is the gross receipts reduction. And this is very similar to the PPP, except that it is a 50% reduction instead of 25. And then the other way that you can qualify, and this is an either or, it doesn't have to be both. It's one or the other, is if business operations were totally or partially suspended due to a government order. And this second bullet is the one that we're going to spend a little bit more time on, because it's really a case-by-case basis. The gross receipts reduction is clear cut. You either make it or you don't. And then the kind of a complicating factor, and it's why I was talking about it a little bit with the PPP forgiveness, is you cannot receive an employee retention credit for payroll costs that were paid with PPP loan proceeds. So we're going to have to be backing out the PPP loan proceeds on an employee basis in order to calculate this employee retention credit. And then the last item is if you're applying for the 2020 credit retroactively, that is essentially considered income in 2020. So we are holding off on filing any business tax returns that may be eligible for this credit, because we need to calculate the credit before we're able to finish the tax return. Otherwise, we're looking at having to amend the tax returns. All right. And as I said, if you have any questions, feel free to throw them in the chat as we move along. So on the gross receipts test, it is the same. You compare any quarter of 2020 compared to the same quarter of 2019. And if your gross receipt decreased by at least 50%, then you become eligible. And you remain eligible for the credit until your gross receipts reach 80% compared to the same quarter in 2019. So to pick nice round numbers, if you had $100,000 in gross receipts in the second quarter of 2019, and then in 2020 in the second quarter, your gross receipts dropped to $50,000, you would be eligible for the employee retention credit. And then in the third quarter, you went up to $75,000 in gross receipts in 2020. But in 2019, you had the same $100,000. You are still eligible in that third quarter. And then moving forward to the fourth quarter, if your gross receipts went up to 85,000 or 85%, that is the last quarter that you are eligible. So in that example, you would be eligible for the second, third, and fourth quarters for the employee retention credit. The gross receipts is the same definition as the PPP second draw. So it does include state and local grants, interest, dividends, regular revenue, and sales. Does not include capital gains or PPP loan forgiveness. And then down here, bullet is meeting this threshold makes the entire quarter's wages eligible. Because we'll see later on that isn't true with the other test. So the 2021 gross receipts test, it's only a 20% reduction comparing the 2021 quarter to 2019. So it is a lower threshold that you need to meet, but in most businesses' cases, they've bounced back to normal or close to normal. So for 2021, it really is more for the businesses that are still being significantly impacted by Corona. Same thing, meaning this threshold makes the entire quarter's wages eligible. And this is in 2021, it is $7,000 per employee per quarter. And currently it runs through the second quarter. So that's where the $14,000 per employee per year comes from. And then the same thing, if you get the credit for 2021 payroll, it gets essentially picked up as income in 2021. Now the full or partial suspension of operations, and this is where it gets interesting. For a partial suspension, eligible employer continues some but not all of a trade or business operation. And then we have on here, it's a supply concept, not a demand concept. And what I mean by that is if your business was allowed to operate and sales were just down because your customers couldn't get to you, that doesn't count as a partial suspension of operations. So if you're an auto repair shop and you were deemed essential the entire time, you may have seen a massive reduction in sales because people weren't driving. They were at home. But your business wasn't required to work in a reduced capacity. So you wouldn't meet this. But presumably if your sales were significantly down, you may qualify under the gross receipts reduction. If you're able to telework, there's no suspension. So if you had employees that were working from home a couple days a week before the pandemic hit, and then once the pandemic hit, you switched to fully working from home and it didn't really impact your operations, you wouldn't be eligible under this. And then the modifications to operations must have more than a nominal effect on business operations. And for this portion, the credit only applies during the suspension of operations. So if you meet the gross receipts test, you get it for the entire quarter. Under this one, you are only eligible while you have the full or partial suspension of operations. Then down here on the bottom, I'll say that we're hoping for additional guidance, but that's kind of been the theme of the past 12 months. Is we've hoped for additional guidance on a lot of things, but largely not gotten it. So this will be a judgment call on a case-by-case basis that really it's going to be talking through with your CPA about whether or not you qualify for it. So the partial suspension of operations has to be due to a government order. So what is a government order? And that is an order from a city, basically state or local government official requiring you to reduce operations in some way. So if a city mayor requires non-essential businesses to close, that's an order. State emergency proclamation that residents must shelter in place, other than those working for essential business that must travel to and from the workplace. Order from local official imposing curfew, order from a local health department mandating workplace closure for cleaning or disinfecting. What this does not include is suggestions or recommendations. So there's obviously a lot of news press conferences with different politicians who urge you to stay home, to urge you to do this or that. But if there is not a binding order, that does not count for this requirement. So in Michigan, what you're largely going to see this apply with is the governor's executive orders. They've now been switched over to the MDHA orders, but from when most people will qualify back in March, April, May, June of 2020, those were under the governor's executive orders. So I think March, I want to say March 23rd was the first date that businesses were, non-essential businesses were closed. But our office is working on compiling a summary sheet of the different executive orders as they apply to different industries to help us in the discussions to determine whether or not your business met the requirements. So the other thing here is order from local health department mandating workplace closure for cleaning or disinfecting. We saw this with some manufacturing where you needed to say every third day you needed to shut down a line in order to clean and disinfect. In that case, on the day that you were shut down, you'd be eligible for the credit. On the days that you were in operation, you would not be. So you would potentially be looking at being eligible for the credit every other day or every third day, depending on how that shutdown worked. So now I'm going to run through some examples. And most of these examples I pulled directly from the IRS has a website with frequently asked questions for it. And they have about 20 examples out there. These are ones I pulled directly from that site. So we'll go through them. So I have a couple examples for healthcare. This one is a hospital is considered to be operating an essential business under a governmental order with respect to its emergency department, intensive care, and other services for conditions requiring urgent medical care. However, the governmental order treats employer H's elective and non-urgent medical procedures as non-essential business operations and prevents employer H from performing these services. Employer H suspends operations related to elective and non-urgent medical procedures. Although employer H is an essential business, employer H is considered to have a partial suspension of operations due to the governmental order that prevents employer H from performing elective procedures. So that is, and I'm sure some of you probably saw the news, and those of you that work in the hospitals understand that a lot of the medical systems were losing massive amounts of revenue because people couldn't do their knee surgeries. They couldn't come in for heart surgeries. So in this case, they would be eligible. Another example for quite a few of our physicians is you may work both in a clinical setting in your office and also in the hospital. And for some of those physicians, they were still doing the full capacity work in the hospital, but they were not allowed to see patients in the clinic settings. That is going to be on a case-by-case basis, where if a more than a nominal part of your business is in that clinic setting that was suspended, then you may be eligible for this. So another healthcare example is employer operates a physical therapy facility in a city where the mayor has ordered that only essential businesses may operate. Employer D's business is not considered essential under the mayor's order, which requires employer D to close its workplace. Prior to the governmental order, none of employer D's employees provided services through telework, and all appointments, administration, and other duties were carried out at employer D's workplace. Following the governmental order, employer D moves to an online format and is able to serve some clients remotely, but employees cannot access specific equipment or tools that they typically use in therapy, and not all clients can be served remotely. Employer D's business operations are considered to be partially suspended by the governmental order because Employer D's workplace, including access to physical therapy equipment, is central to its operations, and the business operations cannot continue in a comparable manner. So this is one where you were able to transition to remote work in some capacity, but you had more than a nominal impact on the business by not being able to be there in person. One of the points is that if your supply chain is disrupted because someone in your supply chain was not deemed an essential business and therefore couldn't supply you, and you were unable to operate because you didn't have those supplies, you do become eligible for the credit. So this is the example here is Employer A operates an auto parts manufacturing business that is considered an essential trade or business where it operates. Employer A's supplier of raw materials is required to shut down its operations due to a governmental order. Employer A is unable to procure those raw materials from an alternate supplier. As a consequence of the suspension of Employer A's supplier, Employer A is not able to perform its operations. Under these facts and circumstances, Employer A would be considered an eligible employer because its operations have been suspended as a result of the government order that suspended operations of its supplier. And it's important to note in this example that the supply chain has to be disrupted due to a government order. Obviously, supply chains were disrupted across the board, but that was just because of strain on supply chains, not necessarily because of government orders. So that is something that you're going to have to look at closely. So this is an example where I talked about the kind of the supply concept versus the demand concept. So an auto repair business is an essential business and is not required to close its locations or suspend its operations. Due to a governmental order that limits travel and requires members of the community to stay at home except for certain essential travel, such as going to the grocery store, Employer B's business has declined significantly. Employer B is not considered to have a full or partial suspension due to governmental order. So this is where the concept comes in, that if you are allowed to operate fully, you need to meet the gross receipts test. So then kind of get to how do we get the employee retention credit? First, we need to calculate the PPP forgiveness, because those wages that we used for the PPP are not eligible for the ERC. So we need to determine what leftover wages we have for the ERC. And where this gets a little bit more complicated is you obviously have an up to 24-week period that you can elect for PPP forgiveness. The ERC doesn't state how we need to apply the wages that we use for PPP forgiveness. So reasonably, we can apply for PPP forgiveness using the wages anywhere in that 24-week period. So that's where we'll be kind of calculating the PPP forgiveness to back into the greatest eligibility for the employer retention credit. So the second step is, well, this probably should be the first step, determine if you're eligible first. There's no point in going through the calculations and determining your amount if you don't know you're eligible up front. Then obviously calculate the ERC, and then for 2020, we can amend the fourth quarter 941s in order to get the credit for any quarter that we're eligible for or any period that we're eligible for in 2020. For the 2021 credit, it will be filed as part of your regular 941s in the first and second quarter. So just to recap, the clear-cut way is to meet the gross receipts test. The gray area is the government order requirements, which I would encourage you to reach out to us or your CPA to talk through whether or not you meet that requirement. The amount, I mean, we're talking about potentially large dollar amounts for this credit. In hanging out there up to $21,000, realistically, most people are going to be eligible for $5,000 per employee. And then, just please reach out to us if you think you're going to be eligible based on the partial or total suspension, so that we can get this figured out. So that is what I have for the presentation, and then I'll just kind of add at the end to please be patient with the ERC and other relief programs out there. There are a lot of unanswered questions that we would love answers to, but as we've learned in the past year, we're not necessarily going to have those answers in a time that we would like. So it's going to be on a case-by-case basis, really determining who we should move forward with in this process in order to get the credit now, and who is potentially better served to extend the tax return to see if we get additional guidance on their eligibility. So I guess with that, are there any questions? I'll stay on the line for a few minutes. Otherwise, thank you everybody for attending.